Hello everyone, welcome to our YouTube channel Covida Alpha Capita Stock Analysis. And in today's video, we are going to see about the book Security Analysis and why Warren Buffett calls it an investing Bible. This is part one of the video series that we are going to put out next. So stay tuned for another parts. So let's get started with the introduction. This video series is about the book Security Analysis and why Warren Buffett calls it investing Bible. We will cover all the important aspects of this book and give you an overview of the book. Okay, so the lesson 1 of the book is about buybacks, cash flow, dividends, safety in investing based on Graham and Dodd. In Indian market, companies like Infosys, TCS, and Reliance often announce share buybacks. At first, this sounds like good news for investors. The company is returning cash to shareholders, but is it always good? What if the company is overpaying for its own shares? Today, we will begin our journey into Benjamin Graham and David Dodd's classic book, Security Analysis, by exploring this very first question. This is the first video in our playlist where we will simplify the powerful lessons of Graham's work and show how they apply not just to Wall Street but also to Dalal Street, the Indian stock market. Okay, so many companies issue stock options to their employees as a part of compensation. Later, to avoid delusion, they repurchase shares from the open market, but often they end up buying back those shares at much higher prices than what employees paid for the options. So, why this is an issue? This creates a negative cash flow effect. The company is spending more money to repurchase shares than it ever received from the employees, exercising their stock options. For shareholders, this means the company is using valuable cash resources insufficiently. So, the Graham's principle says Graham argues that buybacks should be executed only when shares are undervalued. If a company consistently repurchases its shares during periods of market undervaluation, this is a strong signal for long term investors. Indian example, TCS has conducted buybacks at attractive valuations which rewarded long-term investors. In contrast, companies that conduct buybacks at inflated prices destroy shareholders' value. Concept number 2, cash flow and dividends. Dividends as a signal. Well managed companies does not cut dividends at the first sign of declining cash flow. If management believes the cash flow decline is temporary, they usually maintain dividends to show confidence in the company's future. Why this matters for investors? Stable or steadily rising dividends are a hallmark of quality companies. Cutting dividends, on the other hand, often signals financial stress or weak confidence from management. So, I will give you an Indian example. Companies like Hindustan Unilever and ITC have maintained a consistent dividend record. This attracts value investors who appreciate stability over speculative growth promises. Let's move to concept number 3, financing risk, debt versus equity. Safe projects are financed with debt, risky project financed with equity. Conservative financing project investors. Low risk stable projects are often financed with debt because the risk of default is low. High risk uncertain projects should be financed with equity because equity investors absorb the risk. Why this distinction matters? Conservative financing ensures that shareholders are protected. Companies that take on too much debt for risky ventures put investors in danger of permanent capital loss. I'll also give you an Indian example of it. Reliance Jio initially used equity funding for its massive telecom rollout, which was risky and capital intensive. Once the business became stable, Reliance then added debt financing. This balanced approach aligned with Graham's principle. Let's move to concept number 4, speculation versus safety. Graham's insight on this concept was the future is uncertain, therefore speculative. The past is known, therefore best source of safety. The future is uncertain, therefore speculative. The past is known, therefore the best source of safety. Application. If a company's earnings are declining or even stagnant during times when the overall economy is booming, it signals deep underlying problems. This is a red flag for investors. And why past matters so much? While the future cannot be predicted perfectly, past financial performance provides evidence of resilience, management quality, and business stability. This makes the past a safer anchor for valuation. I'll give you an Indian example for that. During the COVID boom, many pharma companies saw extraordinary earnings, but if a company's earnings declined even in that favorable environment, it indicated a weak competitive position, a warning sign for the investors. Move to key takeaways. Key takeaways were good buybacks only when stock is undervalued. Stable dividends is equal to management confidence. Match debt equity to project risk. Past earnings is equal to safer anchor than uncertain future. Good buybacks are add shareholder value only when the stock is undervalued. Dividends are a reliable signal of management's confidence. Financing decisions should match the risk of the project. Safe project can use debt, risky one should use equity. The future is speculative, but the past offers the safest guide to judging a company's worth. Let's see what we have learned in the first lesson of security analysis. We have seen how cash flows, buybacks, dividends, and financing decisions give us a window into management's quality and a company's long term prospects. In the next video, we will dive into Graham's most famous idea, intrinsic value and the margin of safety, the very foundation of value investing. Subscribe and follow along because this is just the beginning. We have very much more to come. Thank you.